Every modern economy runs on trust. Not gold, not oil, not even productivity alone. Trust. The paper bill in your wallet, the digits in your bank account, the numbers on a government bond, they function because people believe they will hold value tomorrow. Currency is not valuable because of what it is made of. It is valuable because of collective confidence in the system that backs it. When that confidence begins to fracture, the consequences are profound. A currency confidence crisis does not begin with dramatic headlines. It begins subtly. Inflation edges higher than expected. Fiscal deficits widen persistently. Government debt climbs relative to national income. Central banks face political pressure. Investors begin asking quiet questions about long-term sustainability. At first, nothing appears broken. Markets continue functioning. Bonds still trade. The currency still circulates. But beneath the surface, expectations are shifting. To understand how a currency crisis develops, it is essential to understand what supports currency stability in the first place. Three pillars sustain confidence: credible monetary policy, sustainable fiscal policy, and economic productivity. When these pillars align, currency stability feels natural. Inflation remains contained. Debt appears serviceable. Economic growth supports tax revenues. Investors hold sovereign bonds without demanding excessive compensation. The first fracture often appears in fiscal dynamics. Governments spend more than they collect in revenue. In moderate amounts, deficits are manageable. They can stimulate growth during recessions or finance long-term investments. But when deficits become structural rather than cyclical, persistent even during economic expansion, debt accumulates rapidly. As debt grows, interest payments consume larger portions of government budgets. Refinancing becomes more sensitive to interest rate changes. At this stage, markets begin evaluating sustainability. If investors believe the government can grow its way out of debt or implement fiscal discipline, confidence remains intact. But if political polarization prevents reform, doubts deepen. Bond yields may rise to compensate for perceived risk. Higher yields increase borrowing costs, worsening deficits. The cycle feeds itself. Monetary policy complicates the picture. When central banks purchase large quantities of government debt, especially during prolonged periods, questions may arise about independence. If market participants suspect that monetary policy is being used primarily to finance fiscal deficits rather than stabilize inflation, confidence weakens. Currency value is anchored by the belief that supply will not expand uncontrollably. If that belief erodes, expectations of future inflation rise. Inflation expectations are critical because they are self-reinforcing. If households and businesses expect prices to rise rapidly, they adjust behavior accordingly. Workers demand higher wages. Companies increase prices preemptively. Investors shift capital toward assets perceived as inflation hedges. These actions accelerate price pressures. Central banks may attempt to counteract this by raising interest rates. But tightening policy in a highly indebted economy risks financial instability. Currency markets react swiftly to shifts in confidence. Unlike equity markets, currencies reflect national credibility. If international investors perceive declining discipline, capital flows outward. Currency depreciation follows. A weaker currency increases import prices, further fueling inflation. The central bank faces a dilemma: raise rates aggressively or tolerate depreciation. In extreme cases, governments may attempt to stabilize currency through interventions. They sell foreign reserves to buy domestic currency temporarily. However, reserves are finite, and interventions may delay adjustment. Markets often test the resolve of policymakers during these periods. Currency crises are not limited to smaller or emerging economies. While history contains dramatic examples in developing markets, advanced economies are not immune to pressure. High debt to GDP ratios and geopolitical fragmentation influence long-term fiscal sustainability. When a currency starts to wobble, the real danger isn't the economics, it's the speed. I've been tracking how global capital moves, and what's changed isn't policy, it's velocity. Money crosses borders in hours now. A misstep in Washington, and by morning, billions have shifted. Reserve currencies like the dollar used to feel untouchable. But that status only holds if trust holds. And here's the thing most people miss. Trust isn't rational, it's psychological. The moment businesses start invoicing in something else, the assumption of permanence cracks. We saw it in February when the dollar dropped 3.5% in days over tariff uncertainty. Confidence doesn't collapse all at once. But once the conversation shifts, it moves faster than policymakers can react. Investors may hedge more aggressively. Wealthy individuals may diversify assets internationally. These shifts reflect declining confidence. It is important to distinguish between cyclical currency weakness and structural confidence crises. Exchange rates fluctuate routinely based on interest rate differentials, trade balances, and growth expectations. A true confidence crisis involves a broader loss of faith in policy coherence and long-term value preservation. It manifests in sustained depreciation, elevated bond yields, and persistent inflation expectations. Central banks facing a currency confidence crisis must re-anchor expectations decisively. This often requires credible commitment to inflation control, even at the cost of short-term economic pain. Interest rate hikes may need to be aggressive. Fiscal authorities may need to implement consolidation measures. Communication must be clear and consistent. Credibility is rebuilt not through rhetoric alone, but through policy alignment over time. The broader implication is that currency stability cannot be taken for granted. It depends on disciplined coordination between monetary and fiscal authorities. Sustainable debt management and long-term economic competitiveness are crucial. In a world of rising debt levels, the situation becomes increasingly complex. A currency confidence crisis does not necessarily result in hyperinflation or collapse. It often manifests as prolonged volatility, higher borrowing costs, and reduced global influence. However, the risk lies in complacency. Systems built on trust can appear stable until a tipping point is reached. Modern economies are deeply leveraged and rely on continuous debt issuance. Corporations refinance regularly, and financial markets are interconnected globally. If confidence in a major currency erodes significantly, ripple effects would extend far beyond exchange rates. Funding markets, trade flows, and asset valuations would all adjust simultaneously. The true power of a currency lies not in its physical form, but in collective belief. That belief rests on credible policy, sustainable finances, and institutional stability. When those foundations weaken, currency becomes more than a medium of exchange. It becomes a barometer of national credibility. Confidence can take decades to build. It can erode far more quickly. And in a financial system dependent on trust, erosion is the most dangerous trend of all. Welcome to Cash and Chronicles, where money, power, and history collide.